Hi everyone and welcome to this very exciting masterclass. In this session, we are going to discuss about how to improve your credit score. So it's a very exciting topic. Stay in tune for great information. So what are credit scores? So credit scores are an important factor when you borrow money. So maybe you're borrowing money for a mortgage, maybe you're borrowing money for a car loan or on a lines of credit or a personal loan. So any kind of borrowing, the interest rate you pay will be determined by credit score. So once again, credit scores are the factor that determines how much interest rate you pay on any given loan. It could be a mortgage, it could be a car loan, line of credit, or a personal loan. Now, credit is important because cheap credit is like free money. You can get the lowest interest rate anytime you want, but you just have to improve your credit scores. So why it is important? A 2% difference in interest rates on a $100,000 loan will save you $14,000 over a 10-year period. So if you have a personal loan and let's say at 4% or versus getting a personal loan at 6%, the 4% loan that you have got because of good credit rating that can save you effectively $14,000 on a $100,000 loan. That is why improving your credit score is extremely important. Now, let's see what factors go into a credit score. So there are different factors, right? And based on the country you're living in, the model could be slightly different. So this is an example of a FICO model, right? So what does that determine? Credit score, how it is determined based on this model. But these factors are common across countries, right? So percentages could be different, but the factors are common. So what are the factors? So payment history, major component, amount you owed, right? That is a major component. Average age of credit, types of credit, and credit inquiries. So this is the combination of all these factors will determine your credit score. Usually it is in the range of 300 to 900. Higher the credit score, better it is for you when you're borrowing. So let's go one by one in these factors. So first is payment history. So payment history is the largest factor contributing to your credit score. Okay, so what is payment history? Payment history means, have you missed any payment? Have you missed a payment on your utility bill? Have you missed a payment on your credit card? Have you missed a payment on your mortgage? Have you missed a payment on your any kind of credit? It could be a personal loan, anything. If you miss a payment, that stains your record for 7 years. So whatever is the circumstances, pay your bills on time, because the moment the bill becomes non-paid, right, unpaid bill, that stays in your credit report for 7 years. It's hard to recover from that, right, if you miss any payment. So I would always recommend that everyone should set up an auto pay for at least the minimum balance so that you don't end up accidentally missing a payment. So you should always set up an auto pay that pays the minimum balance in case you miss it, right? In case you miss paying the whole balance. You should always pay the whole balance, that is always preferred, but setting up a minimum payment helps you if you miss something. Let's say you're traveling and you couldn't pay your credit card on time, or you couldn't pay your utility bill on time. So this helps you. So setting up auto pays is one of the things that I personally do, right, to stay on top of things. Next is an important and interesting factor. It is the amount that is owed, right, on your credit. So the next biggest factor is the amount owed. This is tricky as it is not just the dollar amount you owe, but the amount of, this is an underlying thing, the amount of utilization you have on the card or you have on the credit. Utilization means how much percent of credit are you using. The lower the utilization percentage, the higher would be your credit score. So example will be having 1,000K monthly spend on a credit card that has 1,000K limit means you have 100% utilization. The company has offered you $1,000 credit, right? And you are using it completely every month, month on month. So that means you have 100% utilization. That will decrease your score, because once again, lower the utilization, higher is our credit scores. So if you have $100,000 credit limit and you're just using $1,000 out of it, so it means 1% utilization. That will improve your credit score tremendously. Okay, the lower the better. Decrease your utilizations if you don't have a spending problem. So if you don't have a spending problem, that is what I do. I recommend you to get the highest possible amount of cards, right, and increase your limits only if you don't have a spending problem. If you're not a good spender, if you don't have control over it, try to lower it. But if you have good control over spending, right, try to increase your credit limit, but use very little out of it. Don't extend it, right, beyond, let's say, 10%. So maybe have multiple credit cards, use 10% of each, and try to increase your credit score that way, so that utilization is always low, even in the case of emergency expense. Okay, that is what I do. But like, ideal number is like 2 credit cards plus line of credit, right? And maybe a secured line of credit, because then the utilization potentially remains low. But a key point to note, do not increase your utilization too much. Try to underutilize your credit. Next is average age. So what is the length of borrowing history you have? So next comes the average age. It is not about how old you are, right? It is about how old your credit lines and credit cards are. So if you ever wonder why your credit drops each time you close a credit card, because probably you have closed a credit card, right, that was very old. You got that credit card when you are 18 years old, right? You're 35 years old right now. So you don't use that credit card and you're closing it. So that will impact your credit score, because that credit is your oldest credit. So because it is an average number that the companies are looking for, so never close your oldest credit, even if you are hardly using it. So just keep it aside. If you're not paying monthly fees on it or annual fees on it, doesn't really bother you. Keep it aside if you're not using it, but do not close your oldest credit. The older it gets, it shows more improvement in your credit scores. Newer lines of credits, you have decisions to make there, but old lines of credits or old credit cards, old credit, don't touch. Okay, then it is number of inquiries. So anytime you apply for a new credit line or new credit, it could be any kind of credit, mortgage, right, personal loan, lines of credit, auto loan, anything. Whenever you have a hard check, whenever the vendor does a hard check, it is marked on your report. Generally, the more inquiries you have on your report, the lower will be your credit score. As lenders see you that you are asking for credit a lot, right, that decreases your credit score. So try to limit your inquiries, right, as much as you can. Only if you have to take credit, then do a hard inquiry on your credit score. So hard inquiry does not mean the online things that you check on Credit Karma or through your bank, like Royal Bank or TD Bank has a credit score. You go and check your credit score, doesn't really impact your credit score. That's not a hard check, that is a soft check. Hard check is when you're going for a borrowing and the vendor checks your credit score. So it could be a bank, a dealership, a car dealership, or a personal loan company. If they are checking your credit score, then it is considered as a hard check and it decreases your credit line. It decreases your credit score. Also, types of credits is important. So lenders want you to have the experience of handling multiple types of credit. So it's a good idea to spread your credits into different sections. So like having a mortgage, having an auto loan, having a credit card, having credit cards, plural, then having, let's say, line of credit, having secured lines of credit, unsecured lines of credit, home equity loan. If you have different types of credit, it adds into your score. the more the variety of credits you have, and the way you're handling is also important. The way you handle those credits, right, that improves your credit score. So getting things like auto loans, mortgages, credit cards, credit lines, etc., it improves your credit score. Now, some red flags that you should be concerned in your credit report if you download that credit report. So one thing is, one common thing, there is not enough credit because you're young or you're a new immigrant into the country. Your credit starts when you take your first credit card or you borrow the first amount, right? So maybe you're new to this country or you're very young, you just started working or something, so you do not have enough credit history. There could be late payments and collections. These are the worst. Try to avoid them as much as you can. The moment things go into collection, it decreases your credit score a lot. So it's very, very important that you do not do late payments, you pay on time, and do not default on your commitments. Then, maxed out credit lines also make you look unreliable. So utilization factor, keep the utilization, right, like 20-30% is fine, right, not beyond that. If you start using 100% or 80% of your credit lines, that creates an issue. Then bankruptcies and foreclosures, they remain on your record longer, so try to avoid it as much as you can, the bankruptcy and foreclosure procedures. Now, some strategies. So if you are very young and you don't have the capacity to take credit right now, so it's a good idea to be an authorized, especially if you have young children for whom you want to build credit history. It's a very good idea to have them as an authorized user. So you can piggyback on the credit card of someone who has great credit or a better credit than you. So, but whenever you're doing that, make sure that their history is good. Now, this strategy works for parents who want to build credit history for their young kids. So maybe the kid is 16, 17, you can like, or 18. They don't have the capacity to pay, but you want to build their credit history. So have them as an authorized user. Or maybe you have a spouse who doesn't have good credit history. So you can have her or him as the authorized user, so you can piggyback of each other's good credit. Then keep your utilizations lower than 10%. Sometimes 10% is very hard, but try to keep it like as low as you can. The lower the utilization, better is the credit scores. And pay down your balances right on time. This is reflected in just 2 to 4 weeks. If you pay everything off, your credit scores will start improving in 2 to 4 weeks. So it's not very easy. Pay on time, don't use too much credit, right, don't max out your limits, right, and give it time. Okay, thank you for attending. See you in the next masterclass.